Imagine this. You take the money you've been saving for years and make your first investment. But there's a mistake you make without even realizing it. And as a result, thousands of dollars go up in smoke. Today, we'll talk about the most common pitfalls investors fall into in 2025. And let me tell you, most of these mistakes are very simple but easily overlooked. So watch this video to the end because it might prevent you from making the most expensive mistake of your life. Remember, content like this can help you take much more informed steps in the investment world. If you want to be among the first to hear the latest news, don't forget to subscribe and turn on notifications. Let's get started. Many new investors choose certain cities simply because they are popular. But in reality, a city's investment return is shaped by population growth, job opportunities, and rental demand. For example, everyone may be talking about Miami, but if tech companies are growing in Austin during the same period, the opportunities there may be much more profitable. Choosing the wrong city means not finding tenants or losing value while waiting for appreciation. That's why you should ask yourself, can people find jobs in this city? Is the population growing? Is there a young population? Before investing, interest rates in 2025 will be a big test for investors. Many people take out loans thinking, the house will pay for itself anyway. But the reality is that rental income sometimes doesn't cover the loan. Let's say you have a $2,000 loan payment, but you can only get $1,800 in rent from that house. In this case, you have to put money out of your own pocket every month. The trap investors fall into is this. They think the house will appreciate in value over the long term and ignore the cash flow. However, the most critical issue for investors is cash flow, i.e., what is actually left in their pocket at the end of the month. Many amateur investors forget about cash flow while thinking the house price will increase. Yes, the house may increase in value, but you will have monthly expenses such as electricity, maintenance, and property taxes. If you don't factor these in, you may be making a profit on paper while constantly losing money out of pocket.
For example, I had an investor friend in Chicago. He thought he was renting his house for $2,500, but with taxes, maintenance costs, and the risk of vacancy, he was actually losing $500 every month. So, while expecting a profit, he was losing money. To avoid ending up in such a situation, you need to calculate all expenses from the very beginning. Now I'm going to tell you about one of the most common pitfalls for new investors in America, chasing popular areas that everyone else is chasing. You know, when a city or neighborhood starts trending, everyone hears the same thing. Homes here will skyrocket in value. Buy in this neighborhood, prices will soar. Everyone is buying here, don't be late. When this happens, most amateur investors rush there without thinking. Because herd mentality kicks in. But the reality is this, by the time you get there, that opportunity is already long gone. Lightbulb example 1, the Miami craze. Let's take Miami, for instance. Especially after 2020, with the surge in migration, tourism, and investment, home prices in Miami skyrocketed. Everyone was shouting, invest in Miami. But many amateur investors who bought homes in Miami during that period realized 2 years later that the rent from their homes didn't even cover the expenses. Because yes, the value increased, but the cash flow, i.e., the monthly cash flow, was zero. So the value of the home increased, but the investor had to put money out of their pocket every month. Lightbulb example 2, Austin, Texas. Another example is Austin. With tech companies moving there, an incredible hype formed. Newspapers wrote, this will be the new Silicon Valley. The result? Thousands of investors rushed to Austin. House prices ballooned. But guess what happened? At some point, demand slowed down, rents didn't increase, and in some areas, they even dropped. So, the investor who bought the house at a high price couldn't find the rental income they expected while paying high mortgage payments. The critical point here is this. If you enter an area just because everyone else is rushing there, your chances of seizing an opportunity are very low. Because the first to seize opportunities in the market are usually large investors or locals. You, on the other hand, are like a passenger boarding the train late. That's why, instead of chasing popular areas, you need to think a little more research-oriented. White heavy checkmark. So what should you do? Do local analysis. Look at the ratio of rents to house prices. If the rental yield is very low compared to the value of the house, there is no opportunity there. Look at developing areas. Focus not on neighborhoods that everyone knows, but on areas that are just coming to the fore and have growth potential. Think long-term. A popular area may seem attractive today, but real investment is made with 5 to 10 years in mind. Pushpin summary. Chasing popular areas sounds safe because everyone is doing it. But the reality is that most investors lose money this way. If you really want to make a profitable investment, you should do your own research and seize opportunities at the beginning stage, not when the trend is at its peak. Let me be clear, if you only act based on herd mentality, you will end up paying the price for someone else's profits. Many amateur investors invest with the dream of quick profits. Thinking, the value will increase in 6 months, I'll sell, is a big mistake. Success in real estate investment is for the patient. Because real value appreciation emerges over years. Let me give you an example. A house purchased in Los Angeles in 2010 may have gained 20% in value by 2015, but by 2020, it had increased by 80%. So those who were patient won, while those who tried to sell quickly missed the opportunity. Buying a home isn't just about paying the mortgage. Property taxes, insurance, maintenance costs, renovations, these annual expenses can be a burden for investors. Many people make decisions based solely on the home's price, but these additional costs can sometimes be as significant as the main expense. For example, those who buy homes near the beach in Florida have to pay serious amounts for annual insurance. If you don't factor these expenses in from the start, it will be very difficult for your investment to make you money. Many amateurs decide on their own, thinking, I'll just research it online. But the real estate market is much more complex than it appears. Working with professionals like lawyers, real estate consultants, and financial experts can save you from major mistakes. Yes, you'll pay them a fee, but that fee is a much smaller price than the cost of a major mistake you could make. Now let me tell you something. Avoiding these pitfalls will determine not only your current investment but also your future financial freedom. If you really want to take conscious steps in the real estate world, don't forget to subscribe and turn on notifications. Because every new piece of information we share here will put you a few steps ahead of your competitors. Yes, we've talked about the biggest traps investors fall into in 2025. Maybe you don't make some of these mistakes, but remember, even a single mistake can cost you thousands of dollars. So be smart, do your research, do the math, and be patient. Now I ask you, which of these pitfalls do you think is the most dangerous? Write your thoughts in the comments, I'm curious to hear your opinion.